Question 1. The efficiency study reveals that a municipal securities syndicate in California is reviewing its expense reports for a recent bond issuance. A syndicate member has submitted an expense claim that includes costs for a lavish client entertainment dinner held during the offering period, alongside standard costs for printing the preliminary official statement. What is the most appropriate action for the syndicate manager to take regarding this expense claim? In accordance with MSRB Rule G11F, Option A, allocate the entire expense claim to the issue, assuming that any expense incurred during the offering period is a valid syndicate expense. Option B, allocate the cost of printing the preliminary official statement to the issue, but disallow the client entertainment dinner expense as a syndicate expense. Option C, allocate the entire expense claim, including the client entertainment dinner, to the issue as a legitimate syndicate expense. Option D, allocate the cost of printing the preliminary official statement to the issue and seek reimbursement from the specific syndicate member for the client entertainment dinner. Correct answer is B. Allocate the cost of printing the preliminary official statement to the issue, but disallow the client entertainment dinner expense as a syndicate expense. Explanation. Scenario analysis. This scenario presents a professional challenge involving the interpretation and application of MSRB Rule G11F concerning syndicate expenses in municipal securities offerings in California. The core difficulty lies in distinguishing between legitimate syndicate expenses that can be allocated to the issue and expenses that are either personal to a syndicate member or not directly related to the offering process, thereby potentially violating the rule's intent to ensure fair and equitable expense allocation. Careful judgment is required to avoid overcharging the issue or engaging in practices that could be construed as unfair to other syndicate members or the issuer. Correct approach analysis. The best professional practice involves a meticulous review of all proposed syndicate expenses to ensure they are directly attributable to the offering and are reasonable in amount. This approach aligns with MSRB Rule G11F's requirement that syndicate expenses be fairly and equitably allocated among syndicate members and borne by the issue only when directly related to the offering. Specifically, expenses such as printing the official statement, legal fees for the offering, rating agency fees, and advertising costs directly associated with the sale of the bonds are typically considered legitimate syndicate expenses. The firm must maintain clear documentation supporting the necessity and reasonableness of each expense. Incorrect approach is analysis. Allocating all expenses submitted by syndicate members without a thorough review, regardless of their direct relation to the offering, fails to comply with the rule's mandate for fair and equitable allocation and direct relation to the issue. This could lead to the issue bearing costs that are personal to a syndicate member or not incurred for the benefit of the syndicate as a whole, including expenses that are clearly personal to a syndicate member, such as travel and entertainment unrelated to syndicate meetings or marketing efforts for the specific offering, is a direct violation of the rule. These costs are not borne by the issue and should be the responsibility of the individual member. Failing to document the necessity and reasonableness of each expense, even if seemingly related to the offering, creates an environment where improper allocations can occur. Without proper documentation, it is difficult to defend the allocation of expenses if questioned by the MSRB or other regulatory bodies, and it undermines the principle of transparency and fairness. Professional reasoning. Professionals must adopt a proactive and diligent approach to managing syndicate expenses. This involves establishing clear internal policies and procedures for reviewing and approving such expenses, ensuring that all syndicate members understand the criteria for eligible expenses, and maintaining comprehensive records. When faced with ambiguous expenses, seeking clarification from the syndicate manager or legal counsel is crucial. The overarching principle is to act with integrity and in accordance with MSRB rules to protect the integrity of the municipal securities market and ensure fair treatment for all parties involved. Question 2. System analysis indicates that a municipal securities principal in New York is overseeing a new bond issuance for a municipality where the principal's sibling serves as the chief financial officer. The principal is aware of this familial relationship. What is the most appropriate ethical and regulatory approach for the principal to take regarding this bond issuance? Option A. Rely on the issuer's CFO to manage the disclosure of the relationship to the municipality and any relevant parties, as they are directly involved with the issuer. Option B. disclose the familial relationship to the issuer, the firm's compliance department, and ensure that the disclosure is made available to potential investors, and seek independent review of the transaction's fairness. Option C. Minimize the significance of the relationship and proceed with the transaction, believing it is a minor personal connection that would not influence professional judgment. Option D. Proceed with the transaction, assuming the issuer's CFO will act impartially and manage any potential conflicts internally, as the relationship is purely personal. The correct answer is B. Disclose the familial relationship to the issuer, the firm's compliance department, and ensure that the disclosure is made available to potential investors, and seek independent review of the transaction's fairness. Explanation. System analysis indicates that ensuring appropriate ethical practices in municipal securities is paramount, especially when dealing with potential conflicts of interest. This scenario is professionally challenging because it requires a principal to balance the firm's business interests with their fiduciary duty to clients and adherence to regulatory standards. The principal must exercise sound judgment to prevent even the appearance of impropriety, which can erode investor confidence and lead to regulatory sanctions. The best professional practice involves proactively identifying and disclosing any potential conflicts of interest to all relevant parties, including the issuer and the investing public, and seeking independent review or guidance. This approach prioritizes transparency and client protection, aligning with the ethical principles and regulatory requirements of the Municipal Securities Rulemaking Board, MSRB, and the Securities and Exchange Commission, SEC, for municipal securities activities in the United States. Specifically, MSRB Rule G17 on fair dealing and MSRB Rule G20 on gifts and political contributions are critical here. By disclosing the relationship, the principal ensures that all parties are aware of the potential influence, allowing them to make informed decisions and mitigating the risk of undue influence or preferential treatment. An approach that involves proceeding with the transaction without disclosing the personal relationship with the issuer's CFO is professionally unacceptable. This failure constitutes a direct violation of MSRB Rule G17's fair dealing provisions, which mandate that dealers treat all customers fairly and not engage in deceptive or manipulative practices. It also creates an appearance of impropriety, undermining investor trust. Another professionally unacceptable approach is to rely solely on the issuer's CFO to manage the disclosure, assuming they will act impartially. While the CFO has a duty to their municipality, the responsibility for ensuring fair dealing and avoiding conflicts of interest ultimately rests with the municipal securities firm and its associated persons. Delegating this responsibility without active oversight and independent confirmation is a dereliction of duty. Finally, an approach that involves minimizing the relationship's significance and proceeding without formal disclosure, believing it is a minor personal connection, is also professionally unsound. The perception of a conflict is as damaging as an actual conflict. Regulatory bodies, including the MSRB, emphasize the importance of avoiding even the appearance of impropriety. This approach fails to recognize the potential for even subtle influence and the strict ethical standards expected in the municipal securities market. Professionals should adopt a decision-making framework that begins with identifying potential conflicts of interest. This involves a thorough understanding of personal and professional relationships that could influence business decisions. Once identified, the next step is to assess the materiality of the conflict and its potential impact on clients and the market. The paramount principle should always be transparency and adherence to regulatory requirements, seeking guidance from compliance departments or legal counsel when in doubt. Question 3. During the evaluation of a new municipal bond offering in California, a municipal securities principal notices that the issuer, a small city, has indicated a desire to streamline the disclosure process by providing only a summary of financial information, rather than the full audited financial statements. The principal is aware that the city has not historically undergone a full audit. What is the most appropriate course of action for the principal to ensure compliance with MSRB rules and best practices? Option A. Proceed with the offering using the issuer's summary financial information, assuming that the issuer is acting in good faith and that the summary is sufficient for potential investors. Option B. Recommend to the issuer that they omit any mention of financial audits in the offering documents to avoid confusion or perceived shortcomings. Option C. Advise the issuer that providing full audited financial statements or a clear explanation of why they are unavailable and what alternative disclosures are being made, is crucial for investor protection and regulatory compliance, and offer assistance in understanding these requirements. Option D. Inform the issuer that as long as the summary information is factually correct, the dealer has fulfilled its obligations, and the issuer's disclosure choices are their sole responsibility. The correct answer is C. Advise the issuer that providing full audited financial statements, or a clear explanation of why they are unavailable and what alternative disclosures are being made, is crucial for investor protection and regulatory compliance, and offer assistance in understanding these requirements. Explanation. This scenario is professionally challenging because it requires a municipal securities principal to navigate the complex interplay between issuer needs, regulatory obligations, and the ethical duty to ensure fair and transparent market practices. The principal must balance the issuer's desire for efficient financing with the stringent requirements of the Municipal Securities Rulemaking Board, MSRB, rules, particularly concerning disclosure and fair dealing. The core challenge lies in identifying and mitigating potential conflicts of interest or practices that could disadvantage investors or undermine market integrity. The best professional approach involves proactively seeking clarification and ensuring all necessary disclosures are made in accordance with MSRB Rule G17, Conduct of Municipal Securities Business. This rule mandates that dealers must deal fairly with all persons and not engage in deceptive, misleading, or fraudulent practices. By engaging the issuer directly to understand their disclosure intentions and advising them on their obligations to provide complete and accurate information to potential investors, the principal upholds the highest ethical and regulatory standards. This approach prioritizes transparency and investor protection, which are fundamental to the municipal securities market. An incorrect approach would be to proceed with the offering without fully understanding the issuer's disclosure process or assuming that the issuer's internal review is sufficient. This fails to meet the dealer's obligation under MSRB Rule G17 to deal fairly and avoid deceptive practices. It also risks violating MSRB Rule G47, Information about Municipal Securities, which requires dealers to provide investors with sufficient information to make informed investment decisions. Another incorrect approach is to advise the issuer to omit information that, while potentially burdensome for the issuer, is material to investors. This directly contravenes the spirit and letter of MSRB rules regarding fair dealing and disclosure. Such advice could lead to misinformed investment decisions by investors and expose the dealer to regulatory scrutiny and potential sanctions. Finally, an incorrect approach would be to ignore the principal's concerns and proceed with the offering based solely on the issuer's assurances, without independent verification or further inquiry. This demonstrates a lack of diligence and a failure to uphold the dealer's fiduciary-like responsibilities in the municipal securities market. It neglects the duty to ensure the integrity of the offering and protect investors from potentially misleading information. Professionals should adopt a decision-making framework that begins with identifying potential regulatory or ethical red flags. This involves critically evaluating the information provided by issuers and understanding the dealer's own obligations under MSRB rules. When in doubt, the professional should err on the side of caution, seeking clarification, advising the issuer on their disclosure responsibilities, and ensuring all material information is made available to investors. This proactive and diligent approach is essential for maintaining market integrity and fulfilling regulatory duties. Question 4. What factors determine whether a broker-dealer's sales practices regarding municipal securities in California constitute the employment of manipulative or deceptive devices? Option A. The reliance on a single credit rating agency's opinion while disregarding contradictory negative reports. Option B. The highlighting of tax advantages without a commensurate explanation of the issuer's repayment risks. Option C. The emphasis placed on the security's historical yield without mentioning potential future underperformance. Option D. The completeness and accuracy of disclosures made about the municipal securities risks and the issuer's financial condition. The correct answer is D. The completeness and accuracy of disclosures made about the municipal securities risks and the issuer's financial condition. Explanation. Scenario analysis. This scenario is professionally challenging because it involves a broker-dealer's actions that could be perceived as manipulative or deceptive, even if not explicitly intended as such. The core challenge lies in distinguishing between legitimate sales practices and those that exploit information asymmetry or mislead investors, particularly in the context of municipal securities where disclosure can be complex. A principal must exercise careful judgment to ensure compliance with anti-fraud provisions and maintain market integrity. Correct approach analysis. The best professional practice involves a thorough review of the municipal securities offering documents and any associated disclosure materials to ensure that all material information, including potential risks and financial health of the issuer, is accurately and fully presented to potential investors. This approach directly addresses the prohibition against manipulative and deceptive devices by prioritizing transparency and truthful representation. Aligning with the principles of fair dealing and investor protection mandated by FINRA rules and the Securities Exchange Act of 1934, specifically Rule 10b-5, as applied to municipal securities. Incorrect approaches analysis. Presenting the security solely based on its historical yield without disclosing any potential for future underperformance or changes in the issuer's financial condition is a failure to provide a complete and balanced picture. This omission can mislead investors into believing past performance guarantees future results, which is a deceptive practice. It violates the duty to disclose all material facts and can be construed as manipulative by creating a false impression of security. Focusing only on the security's credit rating from a single agency, while downplaying or ignoring any negative news or analyst reports that might suggest a downgrade, is also a deceptive practice. This selective presentation of information can create an unwarranted sense of security and fail to alert investors to significant risks, thereby violating the anti-fraud provisions. Emphasizing the tax advantages of the municipal security without adequately explaining the underlying risks associated with the issuer's ability to repay the debt constitutes a deceptive practice. While tax benefits are a feature, they do not negate the fundamental risk of default, and failing to disclose this risk in conjunction with the tax benefits can mislead investors about the overall investment proposition. Professional reasoning. Professionals should adopt a framework that prioritizes full and fair disclosure. This involves proactively seeking out all relevant information, both positive and negative, regarding a municipal security and its issuer. When presenting an investment, the focus should be on providing a balanced view that includes all material risks and potential rewards, allowing investors to make informed decisions. This proactive approach, coupled with a commitment to ethical conduct and adherence to regulatory requirements, is crucial for navigating situations involving potential manipulative or deceptive practices. Question 5. Market research demonstrates that a municipal securities principal in California is evaluating a potential underwriting engagement for a new general obligation bond issuance for a mid-sized city. The firm has a long-standing and substantial business relationship with a large real estate developer who is a significant beneficiary of the proposed infrastructure projects funded by the bonds. The principal is aware of this relationship and its potential to create a perception of influence. What is the most appropriate course of action for the principal to ensure compliance with MSRB rules and California state regulations? Option A. Proceed with the underwriting engagement, assuming the city is aware of the developer's influence and that the firm can remain objective in its advice. Option B. Advise the city that while the firm has a relationship with the developer, it is a common occurrence in municipal finance and does not warrant specific disclosure. Option C. Immediately disclose the firm's business relationship with the developer to the city, detailing the nature and extent of the relationship, and seek the city's informed consent to proceed with the underwriting. Option D. Downplay the significance of the firm's relationship with the developer to the city, emphasizing the firm's expertise and commitment to the city's best interests. The correct answer is C. Immediately disclose the firm's business relationship with the developer to the city, detailing the nature and extent of the relationship, and seek the city's informed consent to proceed with the underwriting. Explanation. This scenario presents a professional challenge because it requires a municipal securities principal to balance the firm's business interests with the stringent regulatory requirements governing municipal securities underwriting and disclosure in California. The principal must exercise careful judgment to ensure compliance with the Municipal Securities Rulemaking Board, MSRB, rules and California state regulations, particularly concerning fair dealing and the avoidance of conflicts of interest. The correct approach involves proactively identifying and disclosing potential conflicts of interest to the issuer and the public. This entails a thorough review of the firm's existing relationships and business activities that could reasonably be perceived as influencing the firm's advice or recommendations regarding the proposed bond issuance. By disclosing these relationships, the firm demonstrates transparency and allows the issuer to make an informed decision about whether to engage the firm. This aligns with MSRB Rule G17 on fair dealing with issuers and MSRB Rule G47 on disclosure of conflicts of interest, which mandate that dealers must deal fairly with issuers and disclose any potential conflicts. California state regulations also emphasize ethical conduct and disclosure in municipal finance. An incorrect approach would be to proceed with the underwriting without disclosing the significant business relationship with the developer. This failure to disclose creates a clear conflict of interest, as the firm's potential future business with the developer could influence its advice to the city regarding the bond issuance, potentially leading to terms that are not in the best interest of the city's taxpayers. This violates MSRB Rule G17 and G47, as well as general principles of ethical conduct and fiduciary duty in municipal finance. Another incorrect approach would be to assume that the developer's relationship with the city is common knowledge and therefore does not require specific disclosure by the underwriting firm. Regulatory requirements for disclosure are specific and do not rely on assumptions about what an issuer might already know. The responsibility lies with the underwriting firm to identify and disclose its own conflicts. Finally, an incorrect approach would be to downplay the significance of the relationship or to suggest that it has no bearing on the underwriting process. Even if the firm believes it can remain objective, the appearance of a conflict of interest can be as damaging as an actual one and erodes trust. Transparency and full disclosure are paramount in municipal finance. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a proactive risk assessment process to identify potential conflicts of interest, a commitment to full and timely disclosure to all relevant parties, and a willingness to seek guidance from compliance departments or legal counsel when in doubt. The principle of when in doubt, disclose is a critical tenet for municipal finance professionals. Question 6. Compliance review shows that a municipal securities firm in California, which primarily underwrites and trades municipal bonds, has not explicitly reviewed its client protection procedures in light of the Securities Investor Protection Act of 1970 (SEPA) in over 5 years. As the principal, what is the most appropriate course of action to ensure client assets are adequately protected? Option A. Advise clients that SIP does not cover losses incurred from municipal bond investments, as these are considered more specialized instruments. Option B. Assume that SIP coverage is primarily for equity securities and therefore not a significant concern for a firm focused on municipal bond underwriting. Option C. Review the firm's current procedures against the guidelines outlined in the Securities Investor Protection Corporation (SIPC) brochure and relevant SEPA regulations to confirm coverage for municipal securities and establish a regular review cycle. Option D. Conclude that since the firm is an underwriter, it does not hold customer accounts in a manner that would trigger SIP protection, and no further action is needed. The correct answer is C. Review the firm's current procedures against the guidelines outlined in the Securities Investor Protection Corporation (SIPC) brochure and relevant SEPA regulations to confirm coverage for municipal securities and establish a regular review cycle. Explanation. Scenario analysis. This scenario presents a challenge for a municipal securities principal in ensuring that client accounts are appropriately protected in the event of a brokerage firm's insolvency. The principal must understand the scope and limitations of the Securities Investor Protection Act of 1970 (SEPA) and its application to municipal securities, particularly when dealing with a firm that primarily underwrites and trades these instruments. Misinterpreting SEPA coverage or the procedures for claims can lead to inadequate client protection and regulatory violations. Correct approach analysis. The best professional practice involves proactively understanding the protections afforded by SEPA and ensuring that the firm's procedures align with SIP guidelines for customer protection. This includes recognizing that SIP coverage extends to cash and securities held by a member firm on behalf of its customers, even if those securities are municipal bonds. Firms should maintain accurate records and be prepared to assist customers in filing claims if the firm is unable to meet its obligations. This approach directly addresses the core purpose of SEPA, which is to protect investors from the loss of cash and securities held by a financially troubled member firm. Incorrect approaches analysis. One incorrect approach is to assume that SIP coverage is limited to publicly traded equities and does not apply to municipal securities, especially if the firm's primary business is municipal underwriting. This is a fundamental misunderstanding of SEPA, which covers cash and securities held by member firms for their customers, regardless of the specific type of security, as long as the firm is a SIP member. Another incorrect approach is to believe that the Securities Investor Protection Corporation, SIP, directly reimburses customers for investment losses. SIP's role is to restore customers to the position they would be in if the firm had not failed, by returning cash and securities, or by making payments up to the statutory limits to cover missing assets. It does not guarantee against market losses. A further incorrect approach is to conclude that if a firm is primarily an underwriter of municipal securities and does not hold customer accounts in the traditional sense, SIP protection is irrelevant. SIP membership is based on the firm's business activities, and if it holds customer assets, even in the context of underwriting or trading municipal bonds, those assets are generally covered. Professional reasoning. Professionals must prioritize a thorough understanding of investor protection laws like SEPA. This requires consulting official SIP materials, such as the SIP brochure, and seeking clarification from compliance departments or legal counsel when uncertainties arise. The decision-making process should focus on safeguarding client assets and ensuring adherence to regulatory requirements, rather than making assumptions based on the firm's specific business model or the type of securities traded. Proactive education and adherence to established procedures are paramount. Question 7. Compliance review shows that a municipal securities firm in California has experienced a recent increase in the volume of complex, high-yield municipal bond sales to retail customers. The principal is tasked with ensuring that these activities are conducted fairly. Which of the following approaches best upholds the firm's obligation for fair dealing with its customers under California and MSRB regulations? Option A. Rely primarily on the absence of formal customer complaints related to these transactions as an indication that sales practices are fair and compliant. Option B. Assume that because the firm is adhering to all mandated disclosure requirements for these securities, the sales process is inherently fair. Option C. Conduct a thorough review of sales scripts, customer account documentation, and suitability assessments for these transactions to identify any patterns of potentially unsuitable recommendations or inadequate disclosures, and assess the adequacy of training provided to sales staff on fair dealing principles. Option D. Prioritize sales strategies that maximize the firm's commission revenue from these high-yield municipal bond transactions, provided that basic disclosure documents are provided to customers. The correct answer is C. Conduct a thorough review of sales scripts, customer account documentation, and suitability assessments for these transactions to identify any patterns of potentially unsuitable recommendations or inadequate disclosures, and assess the adequacy of training provided to sales staff on fair dealing principles. Explanation. Scenario analysis. This scenario presents a common challenge in municipal securities principal roles, balancing the firm's business interests with the paramount duty to ensure fair dealing with customers, particularly when dealing with less sophisticated investors. The principal must exercise sound judgment to prevent potential conflicts of interest and ensure that recommendations are suitable and not influenced by undue pressure or personal gain. The challenge lies in identifying and mitigating subtle forms of unfair dealing that might not be immediately obvious. Correct approach analysis. The best professional practice involves a proactive and comprehensive review of the sales practices to identify any patterns or specific instances that could indicate unfair dealing. This includes scrutinizing the suitability of recommendations, the disclosure of material information, and the overall fairness of the transaction process. Specifically, the principal should investigate whether sales representatives are adequately trained on fair dealing principles, whether customer needs are being genuinely assessed, and whether any incentives might be driving inappropriate sales tactics. This approach directly aligns with the Municipal Securities Rulemaking Board, MSRB, Rule G17, which mandates fair dealing with all customers, and the general ethical obligation of principals to supervise their registered representatives effectively. By focusing on the substance of the sales process and the outcomes for customers, this approach ensures that the firm's activities are not only compliant but also ethically sound. Incorrect approaches analysis. One incorrect approach involves solely relying on customer complaints as the primary indicator of unfair dealing. This is insufficient because many customers may not recognize or report unfair practices, or they may be hesitant to complain. This reactive stance fails to meet the principal's affirmative duty to supervise and ensure fair dealing proactively, potentially allowing systemic issues to persist undetected. Another incorrect approach is to assume that adherence to basic disclosure requirements automatically equates to fair dealing. While disclosure is a critical component, fair dealing encompasses more than just providing information. It requires ensuring that the information is understood, that recommendations are suitable, and that the overall transaction is equitable. Overlooking the suitability of recommendations or the potential for undue influence renders this approach inadequate. A third incorrect approach is to focus exclusively on the profitability of transactions for the firm. While profitability is a business objective, it must never come at the expense of fair dealing with customers. Prioritizing firm profits over customer interests creates a direct conflict of interest and violates fundamental ethical and regulatory obligations, potentially leading to unsuitable recommendations and exploitation of investors. Professional reasoning. Professionals in principal roles must adopt a proactive and comprehensive approach to supervision. This involves establishing clear policies and procedures that emphasize fair dealing, providing ongoing training to registered representatives, and regularly monitoring sales activities for any signs of potential misconduct. When reviewing sales practices, principals should look beyond superficial compliance and delve into the substance of customer interactions and transaction outcomes. A robust supervisory system should include regular audits, performance reviews that consider ethical conduct, and a mechanism for employees to report concerns without fear of reprisal. The ultimate goal is to foster a culture of integrity where fair dealing is not just a rule to follow, but a core value of the organization. Question: Compliance review shows that a municipal securities firm in California has experienced a recent increase in the volume of complex, high-yield municipal bond sales to retail customers. The principal is tasked with ensuring that these activities are conducted fairly. Which of the following approaches best upholds the firm's obligation for fair dealing with its customers under California and MSRB regulations? Options: A. Conduct a thorough review of sales scripts, customer account documentation, and suitability assessments for these transactions to identify any patterns of potentially unsuitable recommendations or inadequate disclosures, and assess the adequacy of training provided to sales staff on fair dealing principles. B. Rely primarily on the absence of formal customer complaints related to these transactions as an indication that sales practices are fair and compliant. C. Assume that because the firm is adhering to all mandated disclosure requirements for these securities, the sales process is inherently fair. D. Prioritize sales strategies that maximize the firm's commission revenue from these high-yield municipal bond transactions, provided that basic disclosure documents are provided to customers. Question 8. Compliance review shows that a municipal securities principal in California is responsible for overseeing the disclosure process for a new municipal bond offering. The firm is under pressure to quickly disseminate information to potential investors. Which approach best ensures compliance with disclosure requirements and fair dealing with customers? Option A. Distribute the official statement only when a customer specifically requests it, and consider it sufficient to provide a summary of key features. Option B. Delay the dissemination of any material amendments or supplements to the official statement until after the initial sale of the bonds, and only provide them to customers who inquire further. Option C. Accept the issuer's representations regarding the accuracy of the official statement without conducting an independent verification, assuming the issuer is acting in good faith. Option D. Implement a rigorous internal review of the official statement and all supporting disclosure documents for accuracy and completeness prior to distribution, and establish a system for promptly providing any material amendments or supplements to all affected customers. The correct answer is D. Implement a rigorous internal review of the official statement and all supporting disclosure documents for accuracy and completeness prior to distribution, and establish a system for promptly providing any material amendments or supplements to all affected customers. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a municipal securities principal in California to balance the firm's operational efficiency with the absolute requirement of providing accurate and complete disclosures to customers regarding municipal securities offerings. The principal must ensure that the firm's internal processes do not inadvertently lead to misleading or incomplete information being presented to clients, which could violate MSRB rules and California securities laws. The pressure to quickly disseminate information in a competitive market can create a temptation to cut corners, making diligent oversight crucial. Correct approach analysis. The best professional practice involves a multi-layered approach to disclosure review. This includes a thorough pre-offering review of all official statements and related disclosure documents by qualified personnel to ensure accuracy, completeness, and compliance with MSRB Rule G17 and relevant California regulations. Furthermore, the firm should have established procedures for promptly disseminating any material amendments or supplements to these disclosures to all affected customers. This approach directly addresses the regulatory obligation to deal fairly with customers and provide them with all material information necessary to make informed investment decisions. Incorrect approaches analysis. One incorrect approach involves relying solely on the issuer's representations without independent verification of the accuracy and completeness of the official statement. This fails to meet the principal's duty of oversight and could lead to the dissemination of inaccurate information, violating MSRB Rule G17, fair dealing provisions. Another incorrect approach is to only provide the official statement upon specific customer request, rather than proactively ensuring its availability and dissemination, as required by MSRB Rule G17. This passive stance can leave customers uninformed about material risks and features of the offering. Finally, delaying the dissemination of material amendments or supplements to disclosures until after the initial sale, or only providing them to a select group of customers, is a significant regulatory failure. This violates the principle of fair dealing and MSRB Rule G17, which mandates that customers be informed of all material information in a timely manner. Professional reasoning. Professionals should adopt a proactive and diligent approach to disclosures. This involves establishing robust internal controls and review processes for all offering documents. When faced with time pressures, the professional should prioritize compliance and ensure that all necessary disclosures are made accurately and in a timely fashion, even if it requires additional time or resources. The guiding principle should always be the customer's right to complete and accurate information to make informed investment decisions, in accordance with MSRB Rule G17 and applicable state regulations. Question 9. Process analysis reveals that a municipal securities principal in California is responsible for supervising registered representatives involved in soliciting municipal securities business. Which of the following approaches best fulfills this supervisory responsibility in accordance with regulatory requirements? Option A. Develop and implement comprehensive written policies and procedures for soliciting municipal securities business. Provide regular training to registered representatives on these policies and relevant California regulations, and conduct periodic reviews of solicitation activities to ensure compliance. Option B. Delegate the primary responsibility for monitoring solicitation activities to a junior compliance analyst without establishing specific oversight protocols or regular reporting mechanisms for the principal. Option C. Assume that registered representatives possess sufficient knowledge of solicitation rules and provide only informal, verbal guidance when questions arise regarding municipal securities business in California. Option D. Prioritize the generation of high-volume municipal securities transactions and focus supervisory efforts primarily on the speed and efficiency of trade execution. The correct answer is A. Develop and implement comprehensive written policies and procedures for soliciting municipal securities business. Provide regular training to registered representatives on these policies and relevant California regulations, and conduct periodic reviews of solicitation activities to ensure compliance. Explanation. Scenario analysis. This scenario presents a common challenge for principals in the municipal securities industry in California, balancing the need to generate business with the strict regulatory requirement governing the solicitation of municipal securities business. Principals are responsible for supervising registered representatives and ensuring that all sales practices comply with FINRA rules and state regulation. The pressure to meet sales targets can sometimes lead to overlooking or bending rules, making careful judgment and adherence to regulations paramount. Correct approach analysis. The best professional practice involves a proactive and documented approach to supervision. This includes establishing clear written policies and procedures for soliciting municipal securities business, ensuring all registered representatives receive thorough training on these policies and relevant California regulations, and implementing a robust system for reviewing and approving all communications and sales activities related to municipal securities. Regular audits and performance reviews that specifically assess compliance with solicitation rules are also crucial. This approach directly addresses the principal's supervisory responsibilities under FINRA Rule 3110 and MSRB Rule G27, ensuring that solicitation activities are conducted ethically and legally within California. Incorrect approaches analysis. One incorrect approach involves relying solely on informal verbal guidance and assuming registered representatives understand the nuances of soliciting municipal securities business in California. This fails to establish a clear, documented framework for compliance, leaving room for misinterpretation and potential violations of MSRB Rule G27 and FINRA Rule 3110. Without written policies and regular training, the principal cannot effectively demonstrate supervisory oversight. Another incorrect approach is to focus only on the volume of municipal securities transactions, without a corresponding emphasis on the suitability and disclosure requirements during the solicitation process. This overlooks the core principle of investor protection, which is central to MSRB Rule G15 and G17, and FINRA Rule 2111, as well as California's specific investor protection laws. A principal's duty extends beyond mere transaction volume to ensuring that all recommendations and solicitations are appropriate for the customer, and that all material information is disclosed. A third incorrect approach is to delegate the entire responsibility for monitoring solicitation activities to junior staff without adequate oversight or clear directives. While delegation is a necessary management tool, the ultimate responsibility for supervision rests with the principal. This abdication of responsibility, without a proper framework for the junior staff to operate within, and without the principal's active involvement in reviewing their work, constitutes a failure to meet supervisory obligations under FINRA Rule 3110 and MSRB Rule G27. Professional reasoning. Professionals should adopt a risk-based approach to supervision. This involves identifying areas of potential regulatory exposure, such as the solicitation of municipal securities, and developing comprehensive policies, procedures, and training programs to mitigate those risks. Regular monitoring, testing, and auditing of these programs are essential to ensure ongoing compliance. When faced with potential compliance issues, professionals should err on the side of caution, seeking clarification from compliance departments or legal counsel, and prioritizing investor protection and regulatory adherence above all else. Question 10. Benchmark analysis indicates that a municipal securities firm in California, which is a FINRA member, has total capital of $1,000,000 and allowable liabilities of $200,000. The firm holds $5,000,000 in market value of municipal bonds. Assuming the standard haircut for municipal bonds applies. What is the firm's net capital? Option A, $700,000. Option B, $550,000. Option C, $900,000. Option D, $800,000. Correct answer is B, $550,000. Explanation. Scenario analysis. This scenario presents a professional challenge for a municipal securities principal in California because it requires accurate calculation of a firm's net capital requirement under the Municipal Securities Rulemaking Board, MSRB rules, specifically Rule G17 regarding fair dealing and Rule G8 regarding record-keeping, as interpreted by FINRA rules for firms that are members of FINRA and deal in municipal securities. Miscalculating net capital can lead to regulatory violations, potential financial penalties, and damage to the firm's reputation. The principal must ensure the firm maintains sufficient liquid assets to meet its obligations, especially when dealing with less liquid municipal securities. Correct approach analysis. The best professional practice involves meticulously calculating the firm's net capital by starting with total capital, subtracting allowable liabilities, and then applying haircuts to the market value of securities held. For municipal bonds, the haircut is typically 5% of the market value, unless the security is subject to a higher haircut due to its specific characteristics or market volatility. In this case, firm holds $5,000,000 in municipal bonds. The calculation would be total capital, $1,000,000 allowable liabilities, $200,000 market value of municipal bonds, $5,000,000 haircut on municipal bonds, \0. 05 times $5,000,000 equals $250,000 net capital $1,000,000 $200,000 $250,000 equals $550,000. This approach is correct because it directly adheres to MSRB Rule G8 and FINRA Rule 4110, net capital requirements, by accurately accounting for all capital, liabilities, and applying the appropriate haircut to the securities portfolio. This ensures the firm meets its minimum net capital requirements, safeguarding customer assets and maintaining market integrity. Incorrect approach is analysis. One incorrect approach would be to simply subtract total liabilities from total capital without applying any haircuts to the securities portfolio. This would result in a net capital calculation of $1,000,000 $1,000,000 $200 $000 equals $800 $000. This is incorrect because it fails to account for the potential market risk associated with holding municipal securities, which is a fundamental requirement of net capital rules. The haircut is designed to reflect the potential loss in value of these assets if they need to be liquidated quickly. Another incorrect approach would be to apply a haircut to only a portion of the municipal bond holdings, or to use an arbitrary haircut percentage not aligned with regulatory requirements. For example, applying a 2% haircut to the entire $5,000,000 in municipal bonds would yield a haircut of $0.02 times $5,000,000 equals $100 $000, resulting in a net capital of $1,000,000 $1 $000 $000 $200 $000 $100 $000 equals $700 $000. This is incorrect because it violates MSRB and FINRA rules by not using the prescribed 5% haircut for municipal securities. A further incorrect approach would be to exclude the municipal bonds entirely from the net capital calculation, assuming they are sufficiently liquid. This would lead to a net capital of $1,000,000 $1 $000 $000 $200 $000 equals $800 $000. This is incorrect because all securities held by a firm, including municipal bonds, must be subject to appropriate haircuts to determine net capital, as mandated by regulatory rules. Professional reasoning. Professionals should approach net capital calculations with a systematic and rule-based methodology. First, identify all components of capital and liabilities. Second, determine the market value of all securities held. Third, apply the specific haircuts mandated by MSRB and FINRA rules for each category of security. Finally, perform the net capital calculation. Total capital allowable liabilities haircuts equals net capital. This structured approach ensures compliance and prudent financial management. When in doubt about specific haircut percentages or treatment of particular securities, consult the relevant MSRB rules, FINRA rules, and firm compliance policies, or seek guidance from the Compliance Department. Question 11. Quality control measures reveal that a municipal securities offering document intended for distribution to potential investors in California, contain statements that are being questioned by a reputable credit rating agency regarding their accuracy and completeness. As the principal responsible for overseeing this offering, what is the most appropriate immediate course of action to ensure compliance with the SEC's anti-fraud statutes? Option A. Disregard the rating agency's comments as subjective opinions and proceed with the distribution of the offering document without further internal investigation. Option B. Wait for a formal complaint from an investor regarding the offering document before initiating any review or corrective action. Option C. Proceed with the distribution of the offering document as planned and address any concerns raised by the rating agency's comments after the offering has closed. Option D. Immediately halt the distribution of the offering document and initiate a comprehensive internal review of the question statements in consultation with legal counsel and compliance. The correct answer is D. Immediately halt the distribution of the offering document and initiate a comprehensive internal review of the question statements in consultation with legal counsel and compliance. Explanation. Scenario analysis. This scenario is professionally challenging because it involves a potential misrepresentation of municipal securities to investors, which directly implicates the SEC's anti-fraud statutes. The principal's responsibility is to ensure that all communications and practices adhere to these regulations, even when dealing with complex or potentially misleading information. Failure to do so can result in significant legal and reputational damage for the firm and individuals involved. Careful judgment is required to identify and address such issues proactively. Correct approach analysis. The best professional practice involves immediately halting the dissemination of the potentially misleading offering document and initiating a thorough review. This approach is correct because it directly addresses the immediate risk of violating SEC anti-fraud provisions, specifically Rule 10b-5 under the Securities Exchange Act of 1934, which prohibits fraudulent activities in connection with the purchase or sale of securities. By stopping the distribution and conducting a review, the principal is taking decisive action to prevent further potential violations and to ensure compliance with the anti-fraud mandate. This demonstrates a commitment to investor protection and regulatory adherence. Incorrect approaches analysis. One incorrect approach involves proceeding with the distribution of the offering document while simultaneously planning to address any issues raised by the rating agency's comments later. This is professionally unacceptable because it knowingly exposes investors to potentially misleading information, thereby violating the spirit and letter of SEC anti-fraud statutes. It prioritizes expediency over investor protection and compliance. Another incorrect approach is to dismiss the rating agency's comments as mere suggestions and proceed with the distribution without any internal review. This is a serious ethical and regulatory failure. It demonstrates a disregard for potential red flags that could indicate misrepresentations or omissions, which are central to anti-fraud provisions. Ignoring such feedback can lead to material misstatements or omissions in offering documents, directly contravening the SEC's anti-fraud requirements. A further incorrect approach is to only address the rating agency's concerns if a formal complaint is received from an investor. This is reactive and fails to meet the proactive obligations imposed by anti-fraud statutes. The SEC's anti-fraud provisions require firms to act in good faith and to prevent fraud, not merely to respond to it after it has occurred and harmed investors. Waiting for a complaint is a dereliction of duty and significantly increases the risk of regulatory action. Professional reasoning. Professionals should adopt a proactive and diligent approach when faced with information that could potentially lead to a violation of anti-fraud statutes. This involves 1. Recognizing and assessing potential risks in communications and offerings. 2. Halting any potentially problematic activities immediately to prevent further harm. 3. Conducting thorough internal reviews and seeking expert advice when necessary. 4. Ensuring all disclosures are accurate, complete, and not misleading. 5. Documenting all steps taken to ensure compliance. This framework prioritizes investor protection and regulatory adherence above all else. Question 12. Operational review demonstrates that a registered broker-dealer in New York, which primarily engages in the trading of corporate equities and bonds, has been providing detailed financial analysis and strategic recommendations to several New York State municipal entities regarding their debt issuance plans and the management of their outstanding municipal securities. The firm does not underwrite these securities, nor does it directly solicit the business of the municipal entities. However, the advice provided is instrumental in the entity's decisions concerning the structure, timing, and terms of their bond offerings. Considering the requirements of Section 15A(b)(2) and Section 3A(34)(a) of the Securities Exchange Act of 1934, which of the following best describes the firm's immediate obligation? Option A. Assume no registration is required because the firm does not underwrite municipal securities and its primary business is in corporate securities. Option B. Conduct a thorough review of the specific advice provided to determine if it constitutes municipal advisory activity as defined by regulations, and if so, proceed with registration as a municipal advisor with the SEC and MSRB, ensuring compliance with any applicable exclusions. Option C. Interpret solicitation narrowly to mean only direct requests for advisory contracts, and since this is not occurring, no registration is required. Option D. Conclude that no registration is necessary as the advice is provided to sophisticated institutional clients, municipal entities, and the firm does not directly solicit their business. The correct answer is B. Conduct a thorough review of the specific advice provided to determine if it constitutes municipal advisory activity as defined by regulations, and if so, proceed with registration as a municipal advisor with the SEC and MSRB, ensuring compliance with any applicable exclusions. Explanation. Scenario analysis. This scenario presents a challenge in ensuring compliance with the Securities Exchange Act of 1934, specifically concerning the registration requirements for municipal advisors. The firm's operational review has identified a potential gap in its advisory services, requiring a careful assessment of whether these activities trigger registration obligations under Section 15A(b)(2) and Section 3A(34)(a) of the Act, as interpreted by the Securities and Exchange Commission (SEC) and the Municipal Securities Rulemaking Board (MSRB). Failure to properly register can lead to significant regulatory penalties, reputational damage, and the invalidation of advisory agreements. The core challenge lies in accurately characterizing the nature of the services provided to determine if they constitute municipal advisory activity as defined by the regulations. Correct approach analysis. The best professional practice involves a thorough review of the firm's actual advisory activities against the regulatory definitions of municipal advisory activity. This approach necessitates a detailed examination of the advice provided, the recipients of that advice, and the context in which it is given. Specifically, it requires determining if the firm is providing advice on the advisability of municipal securities or the issuance of municipal securities, or if it is engaging in solicitation activities on behalf of municipal issuers or other municipal entities. If these activities are identified, the firm must then assess whether it meets any exclusions or exemptions. If no exclusions apply, the firm must proceed with the registration process as a municipal advisor with the SEC and the MSRB. This approach directly addresses the regulatory requirements by proactively identifying potential registration triggers and ensuring compliance with the spirit and letter of the law, thereby safeguarding the firm and its clients. Incorrect approach is analysis. One incorrect approach involves assuming that because the firm does not directly underwrite or trade municipal securities, it is automatically exempt from municipal advisor registration. This overlooks the broader scope of Section 3A(34)(a), which defines municipal advisory activity beyond traditional underwriting and trading roles. The regulatory framework is designed to capture entities providing advice that influences municipal issuers' financial decisions, regardless of their primary business line. Another incorrect approach is to rely solely on the fact that the advice is provided to sophisticated institutional investors rather than directly to municipal issuers. While the nature of the recipient can be a factor in certain analyses, core determination of whether advice constitutes municipal advisory activity hinges on the subject matter of the advice and its purpose, not exclusively on the sophistication of the party receiving it. If the advice pertains to municipal securities or their issuance, and is provided in a manner that influences decisions, registration may still be required. A further incorrect approach is to interpret the solicitation aspect of municipal advisory activity narrowly. focusing only on direct requests for business. The MSRB and SEC interpret solicitation broadly to include activities that could reasonably be expected to influence a municipal issuer's decision-making process regarding the issuance of municipal securities or the selection of financial services providers. This approach fails to recognize the expansive interpretation of solicitation within the regulatory context. Professional reasoning. Professionals facing such a situation should adopt a proactive and diligent approach. The decision-making process should begin with a comprehensive understanding of the relevant regulatory definitions and guidance. This involves consulting the Securities Exchange Act of 1934, Sections 15A(b), 2 and 3A, 34A, MSRB rules, and SEC interpretation. The next step is to conduct a granular review of all services provided, documenting the nature of the advice, the parties involved, and the intended outcomes. If there is any ambiguity or a potential for the activities to fall within the definition of municipal advisory activity, the firm should err on the side of caution and seek legal or compliance counsel. This ensures that all necessary steps, including registration, are taken to maintain regulatory compliance and protect the firm's integrity. Question 13. Risk assessment procedures indicate that a California-based municipal issuer is preparing to offer a new series of general obligation bonds. As the principal responsible for overseeing this offering, what is the most prudent approach to ensure compliance with SEC Rule 15C2-12 and relevant state regulations regarding disclosure? Option A. Proactively collaborate with the issuer and their legal counsel to meticulously review the preliminary official statement, confirming it contains all material information as required by SEC Rule 15C2-12 and California disclosure mandates, and that the issuer agrees to provide the final official statement and continuing disclosure commitments. Option B. Focus exclusively on meeting the minimum disclosure requirements outlined in SEC Rule 15C2-12, assuming that California state regulations are either redundant or less stringent. Option C. Distribute the preliminary official statement to potential investors immediately upon receipt from the issuer, and address any disclosure concerns that may arise thereafter. Option D. Accept the issuer's representation that all necessary disclosures have been included in the preliminary official statement without independent verification, assuming their legal counsel has ensured compliance. The correct answer is A. Proactively collaborate with the issuer and their legal counsel to meticulously review the preliminary official statement, confirming it contains all material information as required by SEC Rule 15C2-12 and California disclosure mandates, and that the issuer agrees to provide the final official statement and continuing disclosure commitments. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a municipal securities principal in California to navigate the complex interplay between SEC rules and state-specific disclosure requirements for a new municipal bond offering. The principal must ensure that all material information is disclosed accurately and timely to potential investors, while also adhering to the specific procedural mandates of the SEC's Rule 15C2-12. Failure to do so could result in significant regulatory penalties, reputational damage, and potential harm to investors. The principal's judgment is critical in determining what constitutes material information and ensuring the disclosure process is robust and compliant. Correct approach analysis. The best professional practice involves proactively engaging with the issuer and their legal counsel to ensure that all preliminary official statements are prepared in accordance with SEC Rule 15C2-12 and California's specific disclosure regulations. This includes verifying that the preliminary official statement contains all material information necessary for investors to make an informed investment decision, such as financial condition, operating results, and any potential risks associated with the issuer or the securities. Furthermore, it requires confirming that the issuer has undertaken to provide the final official statement and agrees to the continuing disclosure requirements mandated by the rule. This approach directly addresses the SEC's intent to promote fair and informed markets by ensuring comprehensive and accessible disclosure. Incorrect approaches analysis. One incorrect approach involves relying solely on the issuer's assurance that all necessary disclosures have been made without independent verification. This fails to meet the principal's obligation under SEC Rule 15C2-12 to ensure the accuracy and completeness of the preliminary official statement. Another incorrect approach is to focus only on federal SEC requirements and disregard any additional disclosure obligations that may be imposed by California state law or regulatory bodies, thereby creating a compliance gap. A third incorrect approach is to delay the review of the preliminary official statement until after it has been distributed to potential investors. This is fundamentally flawed as it bypasses the crucial step of providing investors with adequate information before they commit to an investment, directly contravening the spirit and letter of SEC Rule 15C2-12. Professional reasoning. Professionals should adopt a proactive and diligent approach to disclosure. This involves understanding both federal SEC regulations and any applicable state-specific rules. A robust process includes thorough review of all offering documents, direct engagement with issuers and their advisors, and a commitment to ensuring that all material information is disclosed in a clear, accurate, and timely manner. When in doubt about the materiality of information or the adequacy of disclosure, seeking guidance from legal counsel or compliance experts is essential. Question 14. Operational review demonstrates that a municipal securities firm in California has a decentralized approach to handling customer complaints, with registered representatives often resolving issues directly with clients through informal conversations and only escalating significant problems to their direct supervisors. What is the most effective and compliant approach to managing customer complaints under MSRB Rule G6? Option A. Delegate the primary responsibility for complaint investigation and resolution to administrative assistants, with principals providing only periodic, high-level oversight. Option B. Encourage registered representatives to resolve all customer issues informally through verbal discussions, only requiring written documentation if the client explicitly requests it for significant disputes. Option C. Implement a centralized system for logging all customer complaints, assigning each to a designated principal for investigation and resolution, and maintaining detailed written records of all actions taken and the final outcome. Option D. Establish a policy that only written complaints are officially recognized and investigated, with verbal expressions of dissatisfaction being handled at the representative's discretion. The correct answer is C. Implement a centralized system for logging all customer complaints, assigning each to a designated principal for investigation and resolution, and maintaining detailed written records of all actions taken and the final outcome. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to balance the need for efficient operational processes with strict adherence to MSRB Rule G6, which governs the handling of customer complaints. The principal must ensure that all complaints are addressed promptly and thoroughly, without creating undue administrative burdens or compromising the integrity of the firm's compliance procedures. Careful judgment is required to implement a system that is both effective and compliant. Correct approach analysis. The best professional practice involves establishing a clear, documented procedure for receiving, logging, and investigating all customer complaints, ensuring that each complaint is assigned to a designated individual for timely resolution and that a written record is maintained. This approach is correct because it directly aligns with the requirements of MSRB Rule G6, which mandates that firms establish and enforce written procedures for handling customer complaints. The rule emphasizes promptness, thoroughness, and record-keeping, all of which are addressed by this systematic process. It ensures accountability and provides a clear audit trail for regulatory review. Incorrect approaches analysis. One incorrect approach involves relying on informal communication channels, such as verbal discussions between registered representatives and their supervisors, to address customer grievances. This fails to meet the regulatory requirement for written procedures and comprehensive record-keeping. It creates ambiguity regarding the nature of the complaint, the actions taken, and the resolution, making it impossible to demonstrate compliance with MSRB Rule G6. Another incorrect approach is to only investigate complaints that are submitted in writing and to disregard any verbal expressions of dissatisfaction. MSRB Rule G6 does not differentiate between written and verbal complaints. All expressions of customer dissatisfaction must be treated as complaints, and handled according to the firm's established procedures. Ignoring verbal complaints is a direct violation of the rule's intent to ensure all customer concerns are addressed. A further incorrect approach is to delegate the entire complaint handling process to junior administrative staff without any oversight or review by a principal. While administrative staff can assist in logging and initial processing, MSRB Rule G6 clearly places the responsibility for establishing and enforcing complaint handling procedures on the firm's principals. Lack of principal oversight means the process may not be adequately managed, investigated, or resolved in accordance with regulatory expectations. Professional reasoning. Professionals should approach complaint handling by first understanding the specific regulatory requirements, such as MSRB Rule G6, should then design and implement a robust, documented process that ensures all complaints are captured, investigated, and resolved promptly and thoroughly, with appropriate oversight. This process should be regularly reviewed and updated to maintain compliance and effectiveness. When faced with a situation like this, a principal should always err on the side of caution and ensure that all regulatory mandates are met, prioritizing customer protection and firm integrity. Question 15. Compliance review shows that Sterling National Bank, a U.S. bank, has a unit that handles various fixed-income products, including corporate bonds and U.S. Treasury securities, alongside its municipal securities trading and underwriting activities. This unit has a single supervisor overseeing all fixed-income operations. Which of the following best describes the compliance assessment regarding Sterling National Bank's municipal securities operations under MSRB rules? Option A. The municipal securities activities are considered part of a separately identifiable department or division because the bank has a general compliance department overseeing all its financial activities. Option B. The municipal securities activities are likely not conducted within a separately identifiable department or division because the unit lacks organizational and functional distinctness from other fixed-income operations and dedicated supervisory oversight for municipal securities. Option C. The municipal securities activities are considered part of a separately identifiable department or division because the unit handles municipal securities transactions. Option D. The municipal securities activities are considered part of a separately identifiable department or division as long as the unit has a dedicated municipal securities principal, even if other fixed-income activities are commingled. The correct answer is B. The municipal securities activities are likely not conducted within a separately identifiable department or division because the unit lacks organizational and functional distinctness from other fixed-income operations and dedicated supervisory oversight for municipal securities. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a firm to accurately categorize its business activities to ensure compliance with specific regulations governing municipal securities. Misclassifying a department or division can lead to significant regulatory violations, fines, and reputational damage. The core of the challenge lies in understanding the precise definition of a separately identifiable department or division as it pertains to municipal securities activities within a bank, as defined by the Municipal Securities Rulemaking Board, MSRB, in the United States. This requires careful attention to detail and a thorough understanding of the regulatory intent behind the definition. Correct approach analysis. The best professional practice involves a thorough review of the bank's organizational structure and the specific functions performed by each unit. This approach correctly identifies that the municipal securities activities must be housed within a unit that is distinct and clearly delineated from other banking operations. This unit should have dedicated personnel, resources, and supervisory oversight focused solely on municipal securities. This aligns with MSRB Rule G1(a)(i), which defines a separately identifiable department or division as one that is organizationally distinct and has a dedicated municipal securities principal and staff. The intent is to ensure that municipal securities activities are subject to appropriate oversight and compliance procedures, separate from the broader commercial banking functions. Incorrect approaches analysis. One incorrect approach involves simply designating a unit as municipal securities without ensuring it meets the organizational and functional separation requirements. This fails to address the core of the regulatory definition, which emphasizes distinctness and dedicated oversight. It is a superficial classification that does not provide the necessary safeguards. Another incorrect approach is to group municipal securities activities with other fixed-income trading desks. While these might be related, the MSRB definition requires a specific separation for municipal securities to ensure specialized compliance and supervision, distinct from general fixed-income market activities. This approach risks diluting the focus and oversight required for municipal securities. A further incorrect approach is to consider a department as separately identifiable if it merely handles some municipal securities transactions, but also engages in a wide array of other financial services without clear segregation of duties, personnel, or reporting lines. This lack of organizational and functional separation means the unit is not truly distinct and therefore does not meet the regulatory standard. Professional reasoning. Professionals must adopt a proactive and meticulous approach to regulatory compliance. When assessing organizational structures against regulatory definitions, the decision-making process should involve 1. Deeply understanding the specific regulatory language and its intent. 2. Analyzing the firm's internal structure and operations against that definition. 3. Consulting with legal and compliance departments to ensure accurate interpretation and application. 4. Documenting the rationale for classification to demonstrate due diligence. The focus should always be on substantive compliance rather than superficial labeling. Question 16. Analysis of a municipal securities principal's duties in California. Consider a scenario where a firm's registered representatives are actively engaged in selling municipal bonds. What approach best demonstrates the principal's commitment to fulfilling their supervisory responsibilities under California securities laws and FINRA regulations? Option A. Assuming that registered representatives are knowledgeable and will independently adhere to all relevant securities laws and industry regulations without direct oversight. Option B. Implementing and consistently enforcing comprehensive supervisory procedures that include regular training, monitoring of communications, and suitability reviews for all municipal securities transactions. Option C. Focusing solely on addressing compliance concerns only after specific investor complaints or regulatory inquiries have been received. Option D. Delegating the primary responsibility for supervising municipal securities sales activities to administrative staff without direct principal involvement. The correct answer is B. Implementing and consistently enforcing comprehensive supervisory procedures that include regular training, monitoring of communications, and suitability reviews for all municipal securities transactions. Explanation. Analysis of the responsibilities of a municipal securities principal in California presents a scenario that is professionally challenging due to the inherent conflict between fostering business growth and ensuring strict adherence to regulatory mandates designed to protect investors and market integrity. A principal must exercise sound judgment to balance these competing interests, recognizing that compliance is not merely a procedural hurdle, but a fundamental ethical obligation. The best professional approach involves proactively establishing and diligently enforcing robust supervisory procedures that are tailored to the specific risks associated with municipal securities activities conducted by the firm's registered representatives. This includes regular training, clear communication of expectations, and consistent monitoring of sales practices and communications. This approach is correct because it directly addresses the principal's statutory and regulatory duty under California securities laws and FINRA rules to supervise the activities of registered persons. By implementing and maintaining effective supervisory systems, the principal demonstrates a commitment to preventing violations, identifying potential misconduct early, and ensuring that all transactions are suitable and compliant. This proactive stance is the cornerstone of responsible principal oversight. An incorrect approach would be to rely solely on the assumption that registered representatives will independently adhere to all rules and regulations. This failure to implement active supervision creates a significant regulatory gap, as it abdicates the principal's responsibility to ensure compliance. Such an approach violates the spirit and letter of supervisory requirements, which mandate that principals actively oversee their subordinates' activities. Another incorrect approach involves delegating all supervisory responsibilities to junior staff or administrative personnel without adequate oversight or training from the principal. While delegation can be a tool, The ultimate accountability for supervision rests with the principal. This abdication of responsibility can lead to overlooked violations and a breakdown in the firm's compliance framework, exposing both the firm and the principal to regulatory sanctions. Finally, an incorrect approach is to only address compliance issues when a specific complaint or regulatory inquiry arises. This reactive stance is insufficient. Regulatory frameworks emphasize a proactive and preventative approach to supervision. Waiting for problems to surface means that violations may have already occurred, causing harm to investors and damaging the firm's reputation. Professionals should employ a decision-making framework that prioritizes a thorough understanding of applicable regulations, including those specific to California municipal securities. This framework should involve establishing clear policies and procedures, providing ongoing training, conducting regular risk assessments, and implementing a system of continuous monitoring and review. The principal must foster a culture of compliance within the firm, where ethical conduct and regulatory adherence are paramount. Question 17. The review process indicates that a municipal securities principal in California is concerned about ensuring their firm's representatives adhere to MSRB rules regarding public communications and political contributions. The principal is considering different strategies to address these concerns. What is the most effective and compliant approach for the principal to implement? Option A. Develop and disseminate clear firm-wide policies and procedures for all public communications, including social media, and conduct regular audits of representative communications and political contribution records to ensure compliance with MSRB Rules G21 and G37. Option B. Focus compliance efforts solely on formal advertisements filed with the MSRB, assuming other forms of communication are less critical for regulatory oversight. Option C. Wait for client complaints or regulatory inquiries to identify potential violations of MSRB Rules G21 and G37, and then address them on a case-by-case basis. Option D. Instruct representatives that personal social media activity is not subject to firm supervision as long as it does not directly mention the firm's name. The correct answer is A. Develop and disseminate clear firm-wide policies and procedures for all public communications, including social media, and conduct regular audits of representative communications and political contribution records to ensure compliance with MSRB Rules G21 and G37. Explanation. The review process indicates a common challenge in municipal securities principal roles, balancing the need for efficient business operations with strict adherence to regulatory requirements, particularly concerning disclosure and fair dealing. Principals are responsible for supervising the activities of their firm's municipal securities representatives and ensuring compliance with all applicable rules. This scenario tests the principal's understanding of their supervisory obligations and the importance of proactive measures to prevent potential violations, rather than reactive damage control. The correct approach involves a proactive and comprehensive review of all communications, including social media, to identify and address potential rule violations before they occur or are widely disseminated. This demonstrates a commitment to the spirit and letter of MSRB Rule G21 on advertising and communications with the public and MSRB Rule G37 on political contributions and prohibition of municipal securities business with issuers who make political contributions. By establishing clear guidelines and conducting regular audits, the principal ensures that all communications are fair, balanced, and not misleading, and that the firm's political contribution policies are being followed. This approach prioritizes investor protection and regulatory compliance, which are paramount in the municipal securities industry. An incorrect approach would be to rely solely on a complaint-driven system for identifying violations. This reactive stance fails to meet the supervisory obligations of a principal, as it allows potential misconduct to occur and harm investors or the market before any action is taken. It neglects the proactive duty to supervise and prevent violations, which is a cornerstone of MSRB Rule G3 on supervision. Another incorrect approach is to assume that because a communication is made by a representative on their personal social media account, it falls outside the firm's purview. MSRB rules generally extend to communications made by associated persons, even on personal platforms, if they relate to the municipal securities business. Failing to monitor or provide guidance on such communications constitutes a significant supervisory lapse. Finally, an approach that focuses only on the content of advertisements and ignores other forms of public communication, such as social media posts, is incomplete. The MSRB rules on advertising and communications are broad and encompass various methods of reaching the public. A principal must ensure that all forms of communication are compliant, not just those traditionally considered advertisements. Professionals should adopt a robust compliance framework that includes regular training, clear policies and procedures for all communication channels, and a system for ongoing monitoring and supervision. This framework should empower representatives to understand their obligations, while providing principals with the tools to effectively oversee their activities and ensure adherence to all MSRB rules. Question 18. Performance analysis shows that client is interested in investing in a new municipal bond offering in the state of California. The registered representative assisting the client is licensed as a limited representative investment company and variable contracts products. The client asks for the representative's opinion on whether this specific California municipal bond is a suitable investment for their portfolio. What is the most appropriate course of action for the registered representative? Option A. Refer the client to a colleague in the firm who they believe handles municipal bond transactions, without confirming the colleague's availability or specific expertise. Option B. Offer a recommendation on the California municipal bond based on their general understanding of fixed income markets, as they are knowledgeable about investments. Option C. Provide general information about the characteristics of municipal bonds and their potential benefits without offering a specific recommendation on the California offering. Option D. Inform the client that their license does not permit them to provide advice on municipal securities and suggest they consult with a registered representative who is licensed to advise on such products. Correct answer is D. Inform the client that their license does not permit them to provide advice on municipal securities and suggest they consult with a registered representative who is licensed to advise on such products. Explanation. This scenario presents a professional challenge because a registered representative, who is limited to recommending investment company and variable contract products, is being asked to provide advice on a municipal bond offering. The core of the challenge lies in understanding the scope of the representative's license and the potential for exceeding those limitations, which could lead to regulatory violations and harm to the client. Careful judgment is required to ensure that advice provided is within the representative's authorized scope and that any requests outside that scope are handled appropriately. The best professional approach involves recognizing the limitation of the representative's license and politely declining to offer specific advice on the municipal bond. Instead, the representative should inform the client about their licensing limitations and suggest that the client consult with a registered representative who is appropriately licensed to advise on municipal securities. This approach upholds regulatory compliance by adhering strictly to the scope of the Series 53 license, which does not cover municipal securities. It also demonstrates ethical responsibility by prioritizing the client's best interest, ensuring they receive advice from a qualified professional. This aligns with the principles of FINRA Rule 2010, which requires high standards of commercial honor and the principle of fair dealing with customers. An incorrect approach would be to attempt to provide general information about municipal bonds without offering specific recommendations. While seemingly helpful, this can blur the lines of authorized advice and potentially lead the client to believe the representative is providing a level of guidance that is not permitted by their license. This could be construed as an indirect recommendation or an attempt to circumvent licensing requirements, violating FINRA Rule 2010 and potentially leading to disciplinary action. Another incorrect approach would be to offer a recommendation based on general market knowledge without specific licensing. Even if the representative believes they understand municipal bonds, providing advice without the proper registration is a direct violation of FINRA rules governing registration requirements. This exposes both the representative and the firm to significant regulatory risk and could result in severe penalties. Finally, an incorrect approach would be to refer the client to a colleague without first confirming that the colleague is licensed and available to assist. A referral is a good instinct. Failing to ensure the referral is appropriate and effective can still leave the client underserved and the representative potentially liable for not properly facilitating the client's needs within regulatory boundaries. The professional reasoning process in such situations should involve a clear understanding of one's own licensing limitations. When faced with a client request outside that scope, the immediate step is to identify the limitation. The next step is to communicate this limitation clearly and professionally to the client, emphasizing the commitment to their best interests by directing them to the appropriate licensed professional. This proactive and transparent approach ensures both regulatory compliance and client satisfaction. Question 19. The assessment process reveals that a financial advisory firm based in California specializes in providing in-depth research and analytical reports on California municipal bonds to institutional investors. The firm receives a fixed annual retainer from its clients for these services, and its employees do not directly execute trades or hold customer funds. However, the firm's marketing materials suggest that its research is instrumental in guiding clients' investment decisions in these bonds. Considering the requirements of the Securities Exchange Act of 1934, specifically Sections 15A and 15B, which of the following best describes the firm's likely registration obligations? Option A. The firm is exempt from SEC registration as a broker-dealer because it operates solely within California and does not directly execute trades or hold customer funds, focusing only on providing research. Option B. The firm is exempt from SEC registration as a broker-dealer because its primary activity is providing research and analysis, which is considered an advisory service not subject to broker-dealer registration under the 34 Act. Option C. The firm must register as a broker-dealer with the SEC because its activities, including providing research that guides investment decisions and receiving compensation for these services, may be construed as affecting transactions in securities for the account of others, thereby falling under the purview of broker-dealer registration requirements. Option D. The firm is exempt from SEC registration as a broker-dealer because its compensation is based on a fixed annual retainer rather than per transaction fees, and it does not hold customer assets. The correct answer is C. The firm must register as a broker-dealer with the SEC because its activities, including providing research that guides investment decisions and receiving compensation for these services, may be construed as affecting transactions in securities for the account of others, thereby falling under the purview of broker-dealer registration requirements. Explanation. The assessment process reveals a scenario that is professionally challenging due to the nuanced interpretation of what constitutes affecting transactions in municipal securities for compensation, which triggers SEC registration requirements under the Securities Exchange Act of 1934. A firm must exercise careful judgment to distinguish between legitimate advisory services and activities that necessitate broker-dealer registration. The correct approach involves a thorough analysis of the firm's activities to determine if they are engaging in the business of buying and selling municipal securities for others for compensation. This includes evaluating whether the firm is holding itself out as a broker or dealer, soliciting business related to municipal securities transactions, or receiving transaction-based compensation. If these activities are present, then SEC registration as a broker-dealer under Section 15A of the 34 Act is required. This approach is correct because it directly addresses the statutory definitions and intent of the Securities Exchange Act of 1934, specifically Sections 15A and 15B, which aim to regulate entities that engage in the securities business for the account of others or for their own account. The SEC's interpretation and enforcement prioritize investor protection by ensuring that entities facilitating securities transactions are subject to regulatory oversight, including registration, net capital rules, and examination. An incorrect approach would be to assume that simply providing research or analytical reports on municipal securities, even if compensated, exempts the firm from registration if those reports are used to solicit or facilitate transactions. This fails to recognize that the SEC views the provision of advice or research in conjunction with the facilitation of transactions as potentially falling within the definition of a broker or dealer. Another incorrect approach is to believe that operating solely within a single state, such as California, negates the need for SEC registration if the firm's activities involve interstate commerce or are otherwise subject to federal securities laws. Federal registration requirements apply broadly and are not limited by state boundaries for entities engaging in the securities business. Finally, an incorrect approach would be to rely solely on the absence of direct transaction fees, assuming that any other form of compensation for services related to municipal securities transactions does not trigger registration requirements. This overlooks the broad definition of compensation and the SEC's focus on the overall business activity. Professionals should employ a decision-making framework that begins with a clear understanding of the definitions of broker and dealer, as outlined in the Securities Exchange Act of 1934. They must then meticulously analyze the firm's specific activities, compensation structures, and marketing efforts. When in doubt, seeking guidance from legal counsel specializing in securities law or directly consulting with the SEC is paramount to ensure compliance and avoid potential violations. Question 20. Investigation of a municipal securities offering in California by a FINRA-registered broker-dealer reveals that the underwriting spread for a new general obligation bond issuance is 3.5%. The principal is reviewing the preliminary official statement and the proposed disclosure to the client, a sophisticated institutional investor. The registered representative has prepared a summary that highlights the bond's yield to maturity and the firm's role in bringing this attractive opportunity to market. The principal needs to ensure that the firm's conduct adheres to ethical practices and regulatory requirements, specifically regarding disclosure of compensation. What is the most appropriate action for the principal to take to ensure ethical conduct and compliance with MSRB Rule G17 regarding fair dealing with customers? Option A. Suggest the registered representative highlight the firm's long-standing relationships with issuers and investors as evidence of the value provided, without detailing the specific components of the underwriting spread. Option B. Instruct the registered representative to focus the client discussion primarily on the bond's yield to maturity, assuring them that the underwriting spread is standard for such offerings. Option C. Advise the registered representative to simply state the total underwriting spread of 3.5% to the client, emphasizing the firm's expertise in selecting high-quality municipal investments. Option D. Require the registered representative to provide the client with a detailed breakdown of the underwriting spread, including management fee, underwriting fee, selling concession, and reallowance, along with a clear explanation of the firm's services and any potential conflicts of interest. The correct answer is D. Require the registered representative to provide the client with a detailed breakdown of the underwriting spread, including management fee, underwriting fee, selling concession, and reallowance, along with a clear explanation of the firm's services and any potential conflicts of interest. Explanation. This scenario presents a professional challenge because it requires balancing the firm's financial interests with the ethical obligation to provide accurate and unbiased information to clients, particularly when dealing with potential conflicts of interest. The Series 53 exam emphasizes the principal's responsibility to ensure ethical conduct within their firm, which includes supervising employees and upholding regulatory standards. The principal must exercise careful judgment to prevent even the appearance of impropriety, as mandated by FINRA rules governing municipal securities principles. The best approach involves a proactive and transparent disclosure process that prioritizes client understanding and informed decision-making. This includes clearly articulating the firm's role, the associated risks and benefits of the proposed municipal security, and any potential conflicts of interest. Specifically, the principal should ensure that the registered representative provides a detailed breakdown of the underwriting spread, including the components of the gross spread e.g., management fee, underwriting fee, selling concession, and reallowance. This transparency allows the client to understand the costs associated with the issuance and the firm's compensation. Furthermore, the principal must ensure that the firm's compensation is reasonable and commensurate with the services provided, as per MSRB Rule G17, which mandates fair dealing with customers. The principal's role is to supervise and ensure that all disclosures are made in a manner that is not misleading and fully informs the client. An incorrect approach would be to simply state the total underwriting spread without providing a breakdown. This fails to meet the ethical obligation of fair dealing and transparency required by MSRB Rule G17. Clients have a right to understand how the firm is compensated, and withholding this information can lead to a perception of hidden markups or excessive fees, undermining trust and potentially violating the spirit of fair dealing. Another incorrect approach is to focus solely on the yield to maturity without explaining the underlying costs and fees. While yield is a critical factor for investors, it does not fully represent the value proposition or the firm's compensation. This approach can be misleading, as a seemingly attractive yield might mask disproportionately high underwriting costs, which ultimately reduce the client's net return. This also falls short of the fair dealing requirements under MSRB Rule G17. Finally, an incorrect approach would be to emphasize the firm's expertise and the perceived good deal without providing concrete financial details or a breakdown of the spread. While highlighting expertise is part of a firm's value proposition, it cannot substitute for transparent financial disclosure. This approach risks creating an impression of salesmanship over fiduciary responsibility and fails to provide the client with the necessary information to make an informed investment decision, thereby violating the principles of fair dealing and potentially misrepresenting the transaction. Professionals should adopt a decision-making framework that begins with identifying potential conflicts of interest and regulatory obligations. This involves a thorough understanding of MSRB rules, particularly those related to fair dealing and disclosure, e.g., Rule G17. When presenting investment opportunities, the framework should prioritize transparency, clarity, and the client's best interest. This means always providing a complete breakdown of fees and costs, explaining the firm's role, and ensuring that the client fully comprehends the risks and rewards of any proposed transaction. Regular training and supervision by the principal are crucial to reinforce these ethical standards and ensure compliance.